in this case, the enduring wisdom of Benjamin Graham, and really distill the nuggets that truly matter for you.
And today, we are diving into the foundational principles of what we now call value investing.
Mm.
Graham is, well, he's widely known as the father of modern finance, probably the greatest practical investment thinker of all time.
I think that's the key word, isn't it? Practical.
Absolutely. His work is unique because it offers something that, goes way beyond just market commentary. It's a logical, structured approach.
Right. I mean, before Graham came along and really formalized his methodology, investing was, well, in his own words, it was often guided by superstition and guesswork.
Arcane rituals, even.
Exactly. He took that and transformed it into a modern, rational profession with his landmark book, Security Analysis.
And the reason we're still talking about him all these decades later is just the sheer resilience of those principles.
Yeah.
I mean, you think about all the other intellectual structures, these flimsy theories that got completely demolished by financial storms.
.com bust.
The 2008 crisis.
Right.
Graham's work, it just remains fundamentally sound. It teaches you how to avoid ruin, which, is the absolute prerequisite for achieving success.
And he wasn't just some academic in an ivory tower either. I mean, his own experience is just a testament to that resilience. He survived a harrowing loss. What was it, nearly 70%?
Almost 70% during the Great Crash of 29 to 32. An absolutely brutal experience. But he used the wreckage to harvest historic bargains and, well, he went on to thrive.
He certainly did. From 1936 until he retired in 56, his firm, Graham Newman Corp., it achieved one of Wall Street's best long-term records.
Something like 14.7% annually.
Right, compared to 12.2% for the market as a whole. That track record just proves it. Patient rational analysis isn't just a philosophy.
No, it's a strategy. It's a strategy for superior returns.
So our objective for you today is not just a history lesson. We are going to guide you away from the areas of, possible substantial error.
The traps that destroy wealth.
Exactly. And simplify the core tenets that brought really unfailing rewards to his followers. And it all starts with the most basic definition. Okay, so let's unpack this. Graham insists upon a really fundamental, useful distinction between an investor and a speculator.
Oh, absolutely.
And he warns that the disappearance of this distinction is a major cause for concern. So what is the dividing line?
The dividing line is really all about your intent and your method. The speculator's primary interest is in anticipating and profiting from short-term market fluctuations.
So the price movement itself.
That's all that matters. They're focused on momentum, on fear, on greed.
They're essentially betting on psychology.
Precisely. The investor's primary interest, on the other hand, is rooted in the physical world. It's about acquiring and holding suitable securities at suitable prices. And that's based on diligent analysis.
Yeah.
They're focused on the business, not the blip on the screen.
The real danger, and the source material really highlights this, is that Wall Street just improperly applies the term investor to everybody. You see these headlines, small investors bearish, when what they're actually doing is selling short, or calling just reckless buyers reckless investors.
Right, and that blurring of terminology leads directly to poor behavior. When a market turns sour, the exchanges get blamed for these heavy speculative losses that people were never properly warned against.
Because they thought they were invested.
They thought they were playing one game when they were actually playing a completely different and much more dangerous one. If you think you're investing when you're just gambling on price movement, you fail to calculate the true risks.
You can't.
You can't. Graham teaches you have to acknowledge the risk that's inseparable from the opportunities of profit. And you can only calculate that risk if you know what game you're in.
Which is a perfect lead-in to principle number 1. Ownership, not abstraction. This feels like the most fundamental shift in thinking he offers.
It is the bedrock.
And it's a concept that feels like it gets forgotten by every single generation of market participants.
It absolutely is the bedrock of value investing. A share of stock is not just a ticker symbol. It's not an electronic blip on a screen. It is an undeniable ownership interest in an actual operating business.
With factories and employees and products.
Yes. And this ownership stake has an underlying measurable value that does not depend on its daily share price.
I remember the late 1990s so clearly. Stocks became completely decoupled from the companies. It was just pure abstraction.
Oh, totally.
People were trading fractions of companies that had no revenue, no hope of profit.
Right.
But if the ticker symbol was moving up, it was considered a good asset.
And that behavior is the very definition of speculation. The true investor, they view the market as a place to acquire pieces of businesses.
Right.
The speculator views the market as a casino, where they can bet on moving lights. If you lose sight of the fact that you own a piece of a factory or a software license or a distribution network,
You've already lost the game.
you've fallen right into the abstraction trap.
So if the secret to financial success isn't hidden in those market blips, then where is it? This brings us to principle 2, which I think is probably the hardest lesson for people to really internalize.
It's the most difficult, but also the most important. The inner secret to financial success is located inside yourself. It's tied entirely to developing discipline and courage.
So it's not about being smarter than everyone else.
Not at all. Graham is so clear on this. How your investments behave is much less important than how you behave. You had to become a critical thinker, take no Wall Street fact on faith, and invest with patient confidence. And that requires a profound level of self-control.
It sounds almost more like a spiritual or a psychological exercise than a financial one. But where do you find that discipline when, fear or euphoria are running wild?
You find it by refusing. Simply refusing to let the mood swings of other people govern your financial destiny.
That's the ultimate defense.
It is. Emotional contagion, the fear, the euphoria of the crowd, that's the primary mechanism by which speculators lose their money. The investor controls their own mind, regardless of the noise outside.
Okay, so that addresses the internal risk. Principle 3 then defines the external mechanism that's always trying to trip us up.
The price pendulum.
The price pendulum.
The market is just this massive emotional pendulum that forever swings between two irrational extremes. On one side, you have unsustainable optimism.
Which makes stocks way too expensive.
And on the other, you have unjustified pessimism.
Making them too cheap. So the intelligent investor is, first and foremost, a realist. They're not an optimist or a pessimist.
Exactly. They are defined by their action at those extremes. The realist sells to the optimists when prices are inflated and buys from the pessimists when prices are depressed.
Then you're not trying to predict the next swing.
No, that's speculation. You're just waiting patiently for the extremes to show up so you can act rationally.
Even though acting rationally, probably feels deeply uncomfortable when everyone else is either panicking or partying.
It feels awful. That's the hardest thing to do.
And Graham knew how difficult it was.
So how did he help people manage that pressure?
He personified the market's insanity in his most famous analogy. It's the device that lets you psychologically divorce yourself from all that daily toxic noise. And here's where it gets really, really interesting, because we meet the personification of that price pendulum, Mr. Market.
Okay, let's walk through this parable, because it is probably the most powerful tool Graham gives to the defensive investor. Imagine, for you listening, that you own a small share in a private business. You know what it's worth based on its earnings and its assets.
Right. And one of your partners in this business is a fellow named Mr. Market.
And what's he like? Well, Mr. Market is very obliging indeed. Every single day, he shows up at your door and he quotes you a price. He tells you what he thinks your interest is worth, and he offers to either buy you out or sell you his share at that price. No obligation.
But the trick is, Mr. Market is manic depressive.
Completely. Some days, his idea of value is plausible. It's justified by the company's results. But often, his enthusiasm or his fears just run away with him, and the value he proposes seems, as Graham puts it, a little short of silly.
So one day, he's offering you twice what the business is actually worth.
Yeah, he's euphoric, convinced you're on the verge of inventing cold fusion.
And the next day.
Next day, he's in tears, certain that bankruptcy is imminent, and he'll sell you his share for pennies on the dollar.
So a sensible business owner would only trade with this guy when he's being ridiculous.
Of course. If he quotes a ridiculously high price, you sell to him. If he quotes a ridiculously low price, you buy from him.
And the rest of the time.
The rest of the time, you completely disregard his daily chatter, and you focus on the company's operating results and its financial position. That's the real source of value, not Mr. Market's mood.
This just highlights the true power of the investor's advantage. The true investor is almost never forced to sell their shares.
Right. They are free to disregard the current price quotation entirely when it doesn't suit them.
So the market quotations are there for my convenience.
Exactly. Either to be exploited or to be ignored.
So if an investor allows themselves to be stampeded or just worried by these unjustified market declines,
they are perversely transforming their basic advantage, that freedom to choose when to trade, into a basic disadvantage.
I remember reading Graham's stunning conclusion on this point. He said that an investor who is continually stampeded by market fear would literally be better off if their stocks had no market quotation at all.
Yes.
They'd be spared the mental anguish and the bad decisions caused by watching other people's mistakes unfold in real time.
It's the ultimate behavioral lesson. Price fluctuations, fundamentally, have only one significant meaning for the true investor. They provide an opportunity.
An opportunity to buy wisely when prices fall and to sell wisely when they advance.
And if you don't exploit those opportunities, you should just ignore them.
Okay, let's transition that theory to reality because it brings up a critical issue. If this is so simple and powerful, why do the professionals, the supposedly wise, calm operators, so often fail this test?
Yeah, that's the big question.
The source material argues that most professional money managers are forced, just by the structure of their industry, to mimic Mr. Market. They end up buying high and selling low.
The professional money manager faces these systemic handicaps that the private investor just doesn't have. These are structural issues. They're related to size and incentives.
Okay, let's start with size.
First, size. A fund managing billions in dollars cannot invest in small, overlooked businesses. It's just not possible. They have to gravitate toward the biggest stocks, the only ones they can buy in the multi-million-dollar quantities they need to deploy their capital.
Which means they all end up owning the same few, often overpriced giants.
And then there's the cyclical pressure. When the market rises, enthusiasm peaks, and new investor cash just pours into those funds.
So the managers are forced to use that new capital to buy more of the stocks that are already expensive, already have high momentum.
They're forced buyers, further inflating the bubble.
And the reverse is just devastating.
Oh, it's brutal. When the market drops, fear spikes, and investors demand their money back. The managers, who are just forced to buy high, then become forced sellers as the market is scraping the bottom and stocks are finally getting cheap. They have to sell shares just to meet redemptions.
On top of that, they're often forced to specialize. You might be a small cap growth manager or a mid-sized value manager.
Right, and those labels have rules.
So if a small growth stock gets too big, or if a growth stock suddenly drops and gets classified as a cheap value stock,
The manager is forced to sell it, regardless of the underlying business quality. They have to do it just to adhere to their fund's mandate.
their whole world is governed by the quotation, by the daily price.
Because they're measured against benchmarks like the S&P 500 every single quarter, sometimes every day. They are quotation-minded, not value-minded. They can't afford to ignore Mr. Market. They are contractually obligated to follow him.
And we, the public, we often end up imitating this dangerous behavior because we're responding to the same emotional contagion. I mean, look at the real-world example from the early 2000s crash.
The classic behavioral failure. In 1999, when Mr. Market was, as the book says, squealing with delight, average 401k contributions peaked at 8.6%.
People were most eager to buy when prices were at their absolute highest.
Then, by 2002, after the NASDAQ collapsed and stocks were nearly 50% cheaper, prices were finally attractive. But what happened to the behavior?
The average contribution rate just dropped by nearly a quarter, down to 7%.
Exactly. The cheaper stocks got, the less eager people were to buy them. They were imitating Mr. Market's pessimism and fear instead of thinking for themselves and recognizing the bargains.
This is the definition of transforming your advantage into a disadvantage.
It is. For anyone who will be investing for decades to come, falling stock prices are the best possible news.
Yeah.
And yet we treat it like a catastrophe.
That steadiness, that courage is essential. But even the wisest investor is going to be wrong sometimes. I mean, analysis is hard. The future is uncertain. Let's discuss Graham's core protection against that inevitable risk of being wrong, the margin of safety.
The margin of safety is really the conceptual and mathematical basis of all of value investing. It means you have to minimize your odds of error by never overpaying, no matter how exciting an investment seems. The definition is simple. It's the favorable difference between the price you paid and the indicated value of the security.
Let's ground this in a non-financial analogy to make it really accessible.
Think of it like a safety factor in engineering. If you're building a bridge, you calculate that it needs to handle a maximum load of, say, 50 tons.
Okay.
But to ensure absolute reliability, you don't build it to handle just 50 tons. You build it strong enough to handle 100 tons.
So you have a buffer.
Exactly. That extra 50 tons of strength is your margin of safety. It protects you against miscalculation, unexpected future stress, or just plain bad luck.
And applied to investing, that translates directly back to price. The future value of any investment is a function of its present price.
Right. The higher the price you pay, the lower your return will be, and the smaller your margin of safety becomes.
And we tend to forget the ultimate cost of ignoring that margin, especially during these periods of, collective optimism. The math of loss is just terrifying.
It's brutal.
The source material gives a visceral reminder using those speculative dot-com and telecom stocks from the late 90s. By the end of 2002, so many of those names had lost 95% or more of their value.
Once you lose 95% of your capital, the effort required to break even is... It's nearly impossible. You have to gain 1,900% just to get back to where you started.
A 50% loss requires a 100% gain to break even.
Right. But a 95% loss needs a 1,900% gain. Taking a foolish risk can put you so deep in a hole that compounding, the investor's greatest friend, becomes its cruelest enemy. This is why Graham is almost obsessive about emphasizing avoiding losses first.
That focus on sustainable reliability, it explains his total dismissal of these quick speculative formulas.
Oh yeah, speculative formulas, market timing gimmicks, these heavily hyped techniques.
Yeah.
They all share the same siren call. This is quick, this is easy. They're seductive because they promise a reward without any effort, but they fundamentally violate Graham's core principles.
They're seeking temporary rightness.
Instead of long-term sustainable reliability, you might get lucky, but luck is not an investment strategy.
This kind of speculative behavior was just supercharged when financial websites and TV turned the stock market into a non-stop national video game. Investors were drowning in data, but absolutely starved of genuine knowledge.
And the accessibility of trading tools, coupled with sensational media coverage, just encouraged this frantic activity.
Yeah.
People treated stocks purely as abstractions, just blips moving across a screen. The source notes these obscure data points, like Puma Technology shares changing hands every few days in 1999.
100 hours. People couldn't hold a stock for 100 hours.
It's a zero-sum mentality. It's confusing trading with investing.
And thankfully, we have empirical proof that this kind of gambling just destroys wealth. Let's expand on the definitive findings of that Barber and Odin study.
This was a landmark study. It reviewed the trading records of over 66,000 brokerage customers between 1991 and 1996. And the results are just stark. Before you even account for trading costs, the most active traders actually perform pretty similarly to the market.
But the act of trading itself is costly.
Very costly, in commissions and taxes and in your time.
So once those trading costs were factored in, the results for the hyperactive traders were abysmal.
Catastrophic is the word. The most active traders, these are people shifting more than 20% of their stock holdings every single month. They underperform the overall market by an abysmal 6.4 percentage points annually. Annually. Think about what that does over a decade. That is a massive wealth transfer from the trader to their broker, the state, and the federal government. It's not just underperforming. It's guaranteed failure.
And on the other side, the patient investors.
Conversely, the most patient investors, those who traded a minuscule 0.2% of their total holdings in an average month, they didn't just save on fees. They actually slightly outperformed the market.
So the lesson is clear.
Indisputable. And it's behavioral. A long-term investor is the only kind of investor there is. Someone who can't hold on to stocks for more than a few months at a time is just doomed to end up as a victim. You have to stand there and wait. Patience isn't just a virtue, it's a mechanical component of achieving superior results.
That's a powerful bridge. From the psychological need for patience to the mechanical framework that actually enforces it.
Right. And if we connect that behavioral necessity to the bigger picture, Graham provides these practical defensive guidelines. They're designed to minimize the impact of human error. This isn't about finding the next hot stock. It's about maintaining a sound, reliable portfolio structure.
Okay, so the starting point is the most crucial decision, asset allocation, specifically that division between bonds and stocks. What's the basic rule here?
The defensive investor should divide their funds between high-grade bonds and leading common stocks. The core guidance is that the stock proportion should never be less than 25% or more than 75%.
And the inverse is true for bonds.
Exactly. Bonds should range from 75% down to 25%.
And the simplest starting choice, which is often the wisest, is just a 50-50 division.
Right.
So what happens when market movements mess up that proportion?
This is where the mechanical discipline takes over, and it replaces emotion completely.
Right.
Graham champions what he called formula investing, which is just mechanical rebalancing. You rebalance back to your target, say 50-50, when market action disturbs the allocation by a set amount, maybe 5 percentage points.
So if the stock market roars and my stocks climb to 55% of my portfolio,
You are forced to sell stocks and buy bonds. until it's back to 50-50.
And if the market crashes and stocks fall to 45%,
You're forced to sell bonds and buy stocks.
it's an emotional prophylactic.
That's a great way to put it. When the market is euphoric, it forces you to sell, to take profits and reduce risk, even when everyone is screaming that stocks will go to the moon.
Okay.
And when the market is panicking, it forces you to buy, to acquire bargains, even when your gut is telling you to sell everything.
It enforces the rule. Buy low, sell high, without needing a single moment of genius or forecasting.
Exactly. But the mechanics are only half of it. The quality of the components themselves matters.
So if the investor chooses individual stocks instead of an index fund, what should that stock component look like?
The defensive investor has to stick strictly to leading issues, things comparable to what you'd find in the Dow Jones Industrials. And Graham insists on adequate, but not excessive, diversification. He suggests a minimum of 10 different issues and a maximum of about 30.
Why that range?
Below 10 is just too risky. You're not diversified enough. And above 30, the benefits start to diminish, and it just makes active management unnecessarily cumbersome.
And what are the criteria for these large, prominent, and conservatively financed companies?
The requirements are intentionally conservative and rigid. For industrial companies, Graham suggested a minimum of $100 million in annual sales, which was a huge number for his era.
And the dividend record.
Crucially, yes. The company must have a long record of continuous dividend payments. He suggested looking for companies that have been paying dividends continuously since at least 1950.
It proves stability.
And that the business prioritizes its owners. These standards ensure the investor avoids small, volatile companies that are subject to, extreme ups and downs.
Okay, shifting to the bond component. The source material has some fascinating but obviously dated context from the early 1970s. How do we pull the timeless wisdom out of those specific numbers?
Yeah, the exact yields like high-grade corporate bonds at 7.19% or municipals at 5.3% in 1972, those are irrelevant today. But the principle of choice is what remains sound. The investor has to choose between the highest quality taxable bonds, which have the highest yield, and tax-free municipal bonds, which have a lower yield but shelter the return from taxes.
And that decision is just math.
Purely an arithmetic calculation based on your current tax bracket.
So in a modern context, this means comparing things like inflation-protected bonds or TIPIAs versus highly rated corporate debt.
Or weighing the benefits of a high-yield corporate bond fund against a super-conservative short-term treasury fund. The goal is safety and stability, not chasing the highest possible income.
And Graham offers a really powerful warning that transcends any historical yields, the risk of foreign bonds.
He noted that even well-regarded foreign debt, like from Australia or Norway, comes with this profound risk because the owner has no legal way to enforce their claim if geopolitical or financial trouble comes.
Right, you have no recourse.
None. And the example of the Czechoslovakia 8% bonds is just chilling.
It's the ultimate cautionary tale against sovereign risk.
Absolutely. Those bonds traded at 112 in 1928. They collapsed to 6 in 1939. They recovered all the way to 117 in 1946.
And then
Plunged back down to 8 in 1970. That level of volatility and unrecoverable loss spanning decades. It just proves that no yield could ever compensate an investor for taking that kind of political risk.
it's a reminder that even high-quality stocks can't be a better purchase than bonds under all conditions.
Especially when stock prices are exorbitant or when the fixed income option offers true safety against global turmoil.
That sense of humility about expectations is so crucial, especially when we look at periods where logic was just completely abandoned in the pursuit of excitement. Let's get into why chasing the illusions of growth and buying those high PE ratios is so dangerous.
This is the growth paradox. We have seen it again and again, whether it's railroads, chemicals, or tech. Foresight, knowing which industry will grow the fastest, has virtually no real value if everyone else expects the same thing and bids the price up too high.
So you can be 100% right about the growth of an industry.
And still lose money if you paid an astronomical price for the stock.
By the time an industry is obviously the best one to invest in, the prices have already factored in decades of perfect growth,
leaving zero margin of safety. And the reality of long-term corporate earnings is often so underwhelming compared to the market hype. Long-term corporate earnings per share, if you exclude inflation, averages only about 1.5 to 2% annually.
That's it.
That's it. Even in strong periods, like from 51 to 98, net earnings grew about 9.7% annually. The PE ratio trap is set when investors extrapolate short-term phenomenal growth way out into the future, assuming current conditions are permanent.
Growth stocks are only worth buying when their prices are reasonable. Graham warns that when those price-to-earnings ratios go much above 25 or 30,
the odds get ugly. And this intellectual framework applies directly to the modern market. We see companies trading at hundreds of times forward earnings, or even 50 times revenue.
it's the same speculation, just a different sector.
Exactly. Let's use those stunning case studies from the late 90s bull market to illustrate this. Let's start with the contrast between the data storage darling EMC and the stable industrial giant Emerson Electric.
Okay, EMC was the epitome of the aggressive high-growth bet. In 1999, it was trading at 103 times earnings.
103.
And this was driven by the belief that its market dominance meant guaranteed limitless expansion. The CEO was predicting $10 billion in revenue by 2001.
And on the other side, you had Emerson Electric, a conservative, diversified industrial company with predictable, steady growth and a sensible valuation.
So what happened?
The sequel is a brutal lesson in overvaluation. EMC missed its hyper-aggressive forecast. It finished 2001 with only $7.1 billion in revenue and reported a devastating $508 million net loss. The stock, which had priced in perfection, lost 88% of its value by the end of 2002.
And meanwhile, the boring conservative choice?
Emerson Electric, the company nobody talked about at cocktail parties, was down less than 4% over the exact same period. The price paid for the exciting stock introduced catastrophic risk, while the conservative valuation provided a margin of safety that protected the shareholder.
Okay, next up, the high-growth internet infrastructure company, Exodus, versus the reliable logistics forwarder, Expeditors International. This wasn't just a valuation problem.
No, this was a fundamental business sustainability problem. Exodus was pure speculative air. In 1999, it was losing $130 million of minimal revenue, and it carried a crushing $2.6 billion in total debt,
The business was hemorrhaging cash.
devouring over $400 million in cash in 1999 alone. Which leaves the crucial question of how it could ever service its massive debts, let alone pay them down. And yet,
Traders were claiming the stock would climb to infinity and beyond.
that kind of hubris just perfectly embodies the speculative mania Graham warns about. And the inevitable happened.
It went bankrupt.
Exodus stock lost 99.8% in 2001 and filed for Chapter 11, wiping out billions. Expeditors International, the company focused on the predictable, stodgy business of logistics, gained nearly 51% over the same period.
It just proves Graham's warning. Even if the projected growth happens, if you paid too high a price, it still won't bring you any profit.
And if that projection fails to materialize, you face a serious, even total loss.
So for the final contrast, the IPO trap, the phenomenal success of giants like IBM and Microsoft caused this deluge of low-quality public offerings where large losses were virtually guaranteed. Let's look at the internet software company Red Hat versus the established shoe manufacturer Brown Shoe.
Red Hat was a frenzy. It went public in 99, rose 272% on its first day. In just 4 months, shares were up 1,944%, reaching a massive $21.3 billion valuation.
And what was the underlying reality of the business?
The reality was that the business was barely bigger than a large coffee shop. Red Hat had minimal revenue, $13 million over 9 months, and a net loss of $9 million. Its valuation was based purely on the hope that it would become the next Microsoft.
While ignoring the fact that its business was producing red ink.
Meanwhile, Brown Shoe, founded in 1878, was profitable but unpopular. It was losing value in 1999. The market loved the shiny new thing and hated the reliable old thing.
And the market always revalidates Graham's principles in the end.
Always. Red Hat, the company, kept gushing red ink, and the stock lost 94.1% in 2000. Brown Shoe, the stodgy incumbent, trudged out more profits and gained 28% in 2001 and almost 50% in 2002.
Buying a stock just because its price has been going up is a certainty for extreme regret later.
The modern analog to this are high multiple software companies or certain meme stocks whose valuation is totally divorced from their earnings or even revenue. The fundamental logic of overvaluation is the single greatest risk.
The key takeaway from all those failures is that the underlying value of the company matters so much more than the momentum or the excitement around the ticker symbol. But what stands out to me now is that Graham's principles involve more than just stock selection. They involve the ongoing responsibilities you take on as an owner. Exactly. Graham urges shareholders to wake up and exercise care in being a stockholder, not just in becoming one. And this requires piercing through the illusion of knowledge, which is arguably more dangerous than just plain ignorance.
Right. Peter Lynch's famous principle to buy what you know sounds helpful, but when you take it to an extreme, it's lethal. Loving Starbucks coffee or Amazon's quick delivery is not enough.
You have to analyze the financial statements to make sure the stock isn't more overpriced than the product itself.
The enthusiasm for the product just clouds your judgment about the investment.
And even working inside the company is no guarantee of safety.
Not at all. The employees of Enron, Global Crossing, and WorldCom, who concentrated their 401ks in company stock, they learned a terrible truth. Insiders often possess only the illusion of knowledge. They know the corporate culture, maybe their own department, but they rarely have an objective view of the firm's true financial health.
They got wiped out just like everyone else.
So this means the intelligent investor has to become a skeptical, almost cynical reader of financial reports. Corporate accounting is often tricky. What are some of those notorious accounting tricks Graham warned about?
One of the infamous ones is big bath, or kitchen sink accounting. Graham noted this tactic involves management charging off anticipated future losses in a single, already bad year,
Why would they do that?
so that the subsequent year's primary earnings appear artificially inflated. It creates this false impression of a recovery and growth.
So they're hiding future costs in the past.
Precisely. The modern version of this is the prolific use of adjusted EBITDA, or other non-GAAP metrics, which management uses to present a picture of the business that's often much rosier than the reality dictated by standardized accounting.
Another issue that requires investor vigilance is dilution. Dilution from convertible securities, warrants, and most frequently today, executive stock options.
Dilution is critical because it significantly reduces the true per-share earnings. The book gives the example of NVF, where the reported PE ratio of 2 was deeply misleading. After you properly allowed for the dilution and some adverse results, the actual PE ratio was much higher. The stock was far more expensive than advertised.
And dilution leads directly to the problem of stock buybacks. They sound like a shareholder-friendly action, but the motivation is often insidious.
In many large companies today, stock buybacks are not primarily used to return excess capital to shareholders. They're frequently used just to counteract the massive dilution caused by the millions of shares issued to managers who exercise stock options.
So they have to repurchase shares to keep the share count from exploding.
Right, which prevents earnings per share from shrinking. By the early 2000s, companies were spending an astounding 41.8% of their total net income just repurchasing shares.
Wasting shareholder resources to neutralize the cost of executive compensation.
It's capital that could have been reinvested in the business or paid out as proper dividends.
We also need to discuss OPM addiction, the reliance on other people's money. This is a critical red flag when you're looking at cash flow statements.
OPM addiction is when a company relies heavily on debt or stock sales, cash from financing activities, to fund its growth.
Even when the underlying core business isn't generating enough cash on its own.
A healthy business generates cash organically. An OPM addict needs external infusions to survive and grow. Global Crossing and WorldCom showed this clearly. The high infusion of OPM allowed sick, unsustainable companies to appear rapidly growing and dynamic.
So an intelligent investor always has to scrutinize the cash flow statement to see if growth is funded by customers or by creditors.
And if an investor's paying attention, if they read the reports skeptically, and they see these warning signs, and the operating results are clearly below average, Graham urges stockholders to wake up.
Right. And he says the owner has to ask two basic questions. What are they?
The two questions are essential for proper corporate governance. First, is the management reasonably efficient?
And
Second, are the interests of the average outside shareholder receiving proper recognition?
And if the answer to either of those questions is no, Graham says action is required. What's the actionable advice?
He suggests that if results are clearly subpar, shareholders should actually read the proxy material, be open-minded, and be ready to demand changes. He was a huge advocate for shareholder activism. He even suggests that it should become the custom to call in outside business engineers, third-party consultants, to pass upon management competence, much like an outside audit.
That shifts the focus from price watching to business auditing. I love his bold suggestion for enhancing corporate accountability, having one or more professional and independent directors submit a separate annual report.
Yes, addressed directly to the stockholders, detailing whether the business is showing the expected results and whether the outside shareholder is being treated properly. This is the ultimate expression of being an intelligent owner. You audit the business and hold management accountable rather than just reacting to the daily mood swings of Mr. Market. So what does all this mean for you, the listener, today, in a world that's just full of data and market noise? I think the path to superior investment results is often simpler than most people realize. It's rooted in common sense and arithmetic. But paradoxically, it's harder than it looks because the difficulty is entirely behavioral.
And that is why the behavioral contract you mentioned is so crucial. It externalizes the discipline you need internally. It fights that perverse human characteristic that likes to make easy things difficult.
The investment owner's contract is a solemn, written commitment to yourself. It has specific stipulations. A commitment to invest steadily via dollar-cost averaging, never selling because the market is down, and holding for a minimum of 10 years, unless cash is absolutely necessary for an emergency.
You're declaring your refusal to let the herd, or Mr. Market, make your financial decisions for you.
It's your shield against yourself.
This disciplined philosophy, it explains the truly remarkable success of the super investors of Graham and Doddsville.
Figures like Warren Buffett, Charlie Munger, Walter Schloss, they all shared Ben Graham as their common intellectual patriarch, and they applied his theory in different ways. Schloss diversified heavily with over 100 deep value stocks. Munger concentrated his holdings in higher quality businesses, but
Their success wasn't random.
not at all. It was the predictable result of systematically exploiting the persistent gaps between price and intrinsic value. As Buffett noted, they never forgot they were handling other people's money, which reinforces a profound, permanent aversion to loss.
Walter Schloss had the perfect value mantra, which I think summarizes the margin of safety better than any equation. He said, if a business is worth $1 and I can buy it for 40 cents, something good may happen to me.
And he does it over and over and over again. That's the ultimate summary. The secret to value investing has been public for over 50 years. It's been published, taught, and proven.
And yet,
There's still no overwhelming trend toward it. People continue to chase complexity, high prices, and speculative excitement. They choose the high-risk, high-effort path that historically yields lower results.
which brings us to our final provocative thought for you today. Graham teaches that investing is an adventure. The financial future is always an uncharted world. Today's headlines are always full of fearful facts and unresolved risks, whether it's war, corporate fraud, inflation, or political upheaval.
Investors always say they don't like uncertainty.
Right.
And yet uncertainty is the most fundamental and enduring condition of the investing world. It always has been, and it always will be. At its heart, uncertainty and investing are basically synonyms. To be an intelligent investor, to truly put capital at risk based on Graham's principles and endure the inevitable crises, you have to be, at the deepest level, a believer in a better tomorrow.
That faith.
That necessary faith in the future is the core behavioral requirement for adhering to the discipline that he lays out.